Welcome to the Deep Dive, where we unpack the latest earnings calls. Today we're looking at ViaSat, VSAT team. Their recent call definitely turned some heads, didn't it?
It certainly did. You saw that immediate jump in the stock price.
Yeah, over 5% right after the call started.
Exactly. From pre-call to about 30 minutes in. And the after-hours volume was something like 4 times the average. Tells you the market found something compelling there.
Despite some tricky headline numbers, which is what makes this interesting.
Right. Especially that GAAP loss. Investors were clearly looking deeper.
Okay, so let's try and figure out what they saw. First, just the raw numbers, quick snapshot. GAAP EPS, that was a miss.
Yeah.
A loss of just 43 cents versus expectations of around minus something cents.
But then you flip to the non-GAAP number, and that was positive 0.17 cents.
A huge beat against a consensus expectation of what, minus 73 cents.
Massive beat. So right away, that tells you there's more to the story than just the GAAP figure.
And revenue.
Revenue looked good.
Yeah.
$1.171 billion, beating the $1.13 billion expected. That's up 4% year over year.
Okay, decent growth.
Yeah.
And EBITDA.
Adjusted EBITDA came in at $408 million. Up just slightly, 1% year over year, margin around 35%.
And the cash flow picture.
That was a key point. Free cash flow turned positive. Plus $60 million for the quarter.
Ah, okay.
Yeah.
That's significant. And leverage.
Net leverage ended the quarter at 3.6 times LTM EBITDA. Still up there, but the positive cash flow is a good sign.
So yeah, you've got this contrast. GAAP loss, but strong adjusted beat, revenue beat, positive free cash flow.
Yeah.
It really sets the stage for digging into why the market reacted positively.
Absolutely. It wasn't just the numbers for this quarter. It felt like it was also about the strategic direction, maybe the satellite updates, the direct-to-device plans.
And maybe even that activist nudge.
Could be. All pieces of the puzzle. So that reported net loss, the $56 million, primarily driven by higher depreciation and amortization and income tax provision. Standard stuff when you have big assets.
Accounting impacts, basically.
Right. But the operational performance underneath that, that's what drove the positive adjusted EPS. You have to look past the accounting noise sometimes.
And the operational bright spots? Defense, DAT, sounded pretty strong.
Oh, definitely. DAT was kind of the star. Revenue up 15% year over year.
Wow, 15%.
And get this backlog up 49% to $1.1 billion.
49%. That's huge.
It is. And awards in info security and cyber defense were up like 225% year over year. Management specifically pointed to demand for high assurance encryption.
Why the big surge there?
Well, 2 big things, really. One is the threat from quantum computing. Everyone's scrambling for encryption that can withstand that.
Right, future-proofing security.
Exactly. And the second is secure cloud data centers.
Yeah.
Needed for, data fusion, AI applications. It feeds into that whole military concept of
sensor to shooter chain?
Precisely. Getting data securely and quickly from sensor to action. Viasat's tech is right in the middle of that.
Interesting. Okay, what about the commercial side? Aviation?
Aviation, also solid, grew 14% year over year.
Also double tickets.
Yeah, driven by more planes in service, up 9%, and just getting more revenue per plane. Shows recovery in travel and demand for good in-flight Wi-Fi.
So, strong growth in key segments. But the big integration project Inmarsat, how's that going? That's been a major focus.
Management says it's on track. And, you're starting to see some actual proof points now.
Like what?
Well, cost savings from combining ground networks, better deals on procurement because they're bigger now.
Makes sense. Economies of scale.
And look at NexusWave. That's their combined maritime offering. Over 1,000 vessel orders already.
Since launch.
Yeah, and they installed 190 vessels just in Q1 of FY26. That's like double the rate of the previous quarter.
Okay, that is tangible momentum. That's key for getting maritime back to growth, right?
Absolutely. They need that business firing again, and this suggests it's heading that way by year-end FY26. It shows the merger isn't just on paper, it's starting to work operationally.
Good. What if the satellites themselves, the ViaSat-3 constellation, had some issues?
Right, F1 had the antenna problem. But F2 seems to be on track, still scheduled for a second half 2025 launch on an Alice V.
Any updates on the fixes? The reflectors.
They said corrective actions for those deployable reflectors are complete. The satellite should ship to the launch site by end of September 25. So clearing that hurdle is a big deal.
That is a big relief, I bet.
Yeah.
Reduces a major risk factor. And F3.
F3 follows in 2026. Testing on its reflectors is also done. And meanwhile, F1, despite its issues, is still providing service. Over 60,000 flights have used its Wi-Fi.
So Progress on the hardware front.
Yeah.
How does this all tie into their financial strategy? You mentioned positive free cash flow.
Yeah, that's kind of the core of the story now, I think. The shift in financial approach. Deleveraging is the focus.
That's $60 million in positive free cash flow this quarter brings the trailing 12 months to positive $88 million. That feels like a real turning point.
It really does. And they're guiding CapEx down next year, fiscal 26, by about $100 million to $1.2 billion.
So less spending.
Exactly. It signals that pivot from build-out, spending huge amounts on satellites, to harvest, starting to generate cash from those investments.
Right, moving from planting the seeds to collecting the crop, as you said.
Pretty much. They expect sustainable positive free cash flow in the second half of this fiscal year, and they reiterated the goal. Get net leverage below 3 times by fiscal 27.
And paying down debt is the priority.
Yep. First up is that $300 million Inmarsat term loan due in 2026. It's a clear path they're laying out to fix the balance sheet.
Okay, so improved operations, integration progress, satellite fixes, and now this focus on cash flow and deleveraging. What about other strategic things? Direct-to-device.
Yeah, NTN, non-terrestrial networks. ViaSat's approach is interesting. They're pushing for an open, standards-based model using the 5G ecosystem.
To keep costs down.
That's the idea. Lower capital needed, lower operating costs. It's quite different from some competitors talking about billions in new satellite spending for D2D.
So ViaSat wants to use shared infrastructure, more like cloud computing versus everyone building their own data center.
That's a good analogy, yeah. More capital efficient. They're also looking at listing out unused Ka-band spectrum to generate extra cash. High margin revenue. Smart. Okay, and then there's the activist investor angle. Carronade Capital.
Right. They own about 2.6%. Sent that letter end of July pushing for a spinoff of the DAT segment, the defense business.
Why?
They argue DAT is undervalued inside the larger Viasat. A standalone defense tech company might get a much higher valuation from the market. They floated a potential value north of $50 a share just for DAT.
Using a sum of the parts argument.
Exactly. Break the company up, unlock hidden value. Management confirmed they're looking at it as part of their regular portfolio review.
So that potential catalyst is definitely in the mix now. How did this all play out in the Q&A? Anything specific jump out?
Discussion around tactical networking competition like TrellisWare's licensing model, how government standards are evolving for things like UAVs.
Okay.
And more talk about that encryption demand, quantum, AI, secure cloud, linking back to that sensor-to-shooter idea again. They also talk generally about their thinking on spin-offs weighing synergies versus capital needs. Oh, and the Legato settlement is still pending bankruptcy court approval. Got it. So pulling this together for listeners, why does this matter? The stock performance has been pretty incredible lately.
Yeah, the returns are stark. Over the last year, VSE is up 170%.
170% compared to the broader comms sector, the XLC ETF.
XLC is up maybe 28% over the same period, so massive outperformance. Even over 1 and 3 months, Viasat is way ahead. Plus 24% is us, plus 3%, plus 110% is us, plus 12%.
And analysts are noticing this shift.
Seems so. William Blair upgraded to outperform recently, citing that some of the parts upside, potentially over 100%. Zacks called the beat impressive. Needham said it reset expectations. Sentiment seems broadly positive.
What are the key things the market is watching now? Catalysts.
Definitely the ViaSat-3 F2 launch milestones. That's huge. Regulatory nods for their global direct-to-device plans, any movement on that potential date spinoff, thanks to Carronade, and the mid-year guidance update for FY26, especially confirming that free cash flow turn.
So it feels like the narrative could shift from just recovery to actual sustained growth if these hit.
Potentially, yes. It's interesting, right? Management guided to basically flat EBITDA for FY26.
Muted guidance.
Yeah, but the stock still popped 5%. It suggests the market, or at least traders, were maybe more focused on the strategic stuff, the potential deal, the deleveraging story, than the immediate earnings outlook.
Longer-term view, perhaps.
Could be. Anticipating bigger changes down the road.
Okay, let's pivot to our This Is Not Financial Advice segment. Just throwing ideas out there based on what we've discussed.
Purely informational, of course.
Absolutely. So an outrageous but plausible trade idea, building on this, maybe long Viasat.
Okay.
And shorting a competitor. Maybe one that's super reliant on just one satellite system, or one that's announced massive spending on direct-to-device without a clear path to making it pay off efficiently.
Interesting pair trade concept. What's the rationale behind that?
Well, the core idea is that the market might still be undervaluing Viasat's pivot. That's some of the parts math, especially for DAT. If that gets unlocked, it could be significant upside, like Carronade suggested, maybe $50, plus a share potential just from that.
Right. And management's focus now seems squarely on cutting spending, getting leverage down, generating real cash flow starting later this year. That's a fundamental financial shift.
And their D2D strategy, the shared infrastructure model, just seems potentially more sustainable, more capital efficient than rivals planning these huge risky build-outs that could flood the market.
Less risk of oversupply and poor returns, perhaps. Plus, you have the NexusWave momentum showing the Inmarsat deal is working, solid aviation performance, and those strong tailwinds in the defense encryption space.
So the core business looks solid while they execute this financial turnaround and strategic repositioning.
But you have to consider the risks, always.
Definitely. What are the big watch-outs here?
Execution risk is number one. The ViaSat-3 F2 and F3 launches have to go smoothly. Any more satellite problems would be a major setback. And that flat EBITDA guidance for FY26. It does suggest immediate growth might be muted. It could take time for the operational leverage to really show, depending on the market and when or if strategic deals happen.
And the Legato settlement timing is still up in the air.
Right. So risks remain.
Okay, so to wrap up our deep dive today, ViaSat seems to be navigating a complex transition, focusing growth in areas like defense and aviation, managing the huge Inmarsat integration, fixing satellite issues, and fundamentally shifting its financial strategy towards deleveraging and cash generation.
While also dealing with activist pressure and potentially reshaping its portfolio, it's a lot of moving parts.
It really is. So maybe the final thought for everyone listening is this. How does ViaSat's embrace of this shared infrastructure model for future services, combined with its existing strengths in defense and mobility, position it in the long run?
Is this shift from being primarily a builder to becoming a cash-generating operator going to fundamentally change its competitive standing in the satellite industry? What does that mean for rivals?
Something to definitely think about. As always, remember, this was just for informational purposes. Please do your own research before making any investment decisions. Thanks for tuning in to The Deep Dive.